Hello, and thank you for joining us for a brief introduction to RUSI's new report that looks at how authorities can use data analytics to better understand and mitigate money laundering risks. I will walk you through some of the key outcomes of the research that we've conducted on this topic over the past year in cooperation with authorities from a range of different countries. Now, data analytics are often presented as a potential game changer in international efforts to counter illicit financial flows. That expectation is largely justified. However, it will only be met if the various actors have a good understanding of the specific benefits that are associated with data analytics. So the first question that we want to answer with this paper is, how can data analytics specifically support financial intelligence units, FIUs, or financial supervisors in understanding money laundering risks? So the paper reviews a number of use cases. Most of these use cases are designed to detect trends or patterns that would go unnoticed at the level of an individual financial institution. For example, data analytics have been used to determine whether the financial flows leaving a particular area are consistent with economic or demographic characteristics of that area, because any discrepancy between the two can point to higher risks of money laundering. Also, data analytics have been used by FIUs to connect transactions that have been conducted through different financial institutions. Oftentimes, establishing these links is the only way to detect a suspicious activity that cannot be spotted only by looking at individual transactions. Going forward, big data techniques will help authorities make greater use of non-transactional data, which provides essential context in order to understand financial flows. So that includes, for example, data on beneficial ownership or media references. So it is clear from the use cases that data analytics have the potential to make a real difference. However, that potential can only be realized if data analytics are deployed in a strategic and coordinated way, which is why the second question that this paper examines is, how should authorities concretely go about deploying data analytics? The strategy should be informed by a number of factors. This includes very clear objectives about what authorities want to achieve with data analytics, but also a number of contextual factors relating, for example, to the threat landscape in a particular country or data protection standards. Also, authorities should involve the private sector in these efforts in order to maximize the impact of data analytics, and the paper provides a number of recommendations on how to organize that engagement. So what are the next steps? The paper issues 3 broad recommendations. First, FIUs, financial supervisors, and relevant law enforcement agencies should develop a clear strategy to identify and harness the opportunities that are associated with data analytics in the AML context, taking into account the use cases and the factors set out in the paper. This kind of analysis will facilitate a dialogue with policymakers on necessary long-term investments as well as the balance with privacy considerations. Second, regional organizations such as the European Union should foster a dialogue about the experience of their member states in this area in order to encourage a more harmonized approach. Right now, data collection initiatives tend to be fragmented at the international level, which limits their effectiveness. Third, international standard setter and assessment bodies such as the Financial Action Task Force or the International Monetary Fund should more consistently review to what extent member countries have leveraged data analytics for purposes of financial intelligence, supervision, and enforcement. So this is a broad introduction to our paper. Over the next 15 minutes, we will go through some of the specific findings in more detail. Before considering the way forward, it's good to understand where we stand now and how data analytics have been used so far. What are AML authorities seeking to achieve with data analytics? Which data points have been used, and how have those data points been analyzed? AML is a very wide field with many authorities each playing a different role, so the rationale for using data analytics will vary accordingly. The research revealed 2 main categories of objectives. First, the identification of suspicious activities, and second, the enhancement of a risk mapping of supervised entities. So let's first look at the first category of objectives relating to suspicious activities. Under AML regulations, financial institutions and a number of other businesses have an obligation to file a suspicious activity report, a SAR, whenever they have the suspicion that funds might be the proceeds of crime or might be connected to terrorist financing. Now, with the number of SARs increasing from year to year, FIUs have used data analytics to prioritize SARs and determine which SARs pose the highest risk. But also, data analytics can be used to detect suspicious activities that were not reported by financial institutions, either because they simply cannot be detected at that level, or because an institution failed to comply with its obligation to report. Now, moving on to the second category of objectives. AML supervisors have an obligation to adopt a risk-based approach. That means that the allocation of resources should be informed by an understanding of the risks in the sector that they supervise. This is necessary given that supervisory resources are limited. A risk mapping is based on many different factors, including, for example, an entity's governance structure or the reputation of senior managers. But data analytics can be very useful in complementing a qualitative risk assessment by helping supervisors answer questions such as, how has the transaction volume of an institution on a particular corridor evolved over time? And how does that evolution compare with other institutions in the same peer group? That additional information is extremely valuable in order to further enhance the risk mapping of a sector. The next question to consider in order to understand the experience so far relates to the underlying data. In other terms, which data provides the basis for data analytics? Now, the go-to data set in the AML context tends to be the SARS database. By definition, SARS are meant to provide intelligence leads to law enforcement agencies on potential cases of money laundering or terrorist financing, which is why, in many cases, the effectiveness of the SARS regime is based on a review of how many SARs have led to investigations or arrests. However, that is by no means the only way to use SARS. Quite to the contrary, taken as a whole, the SARS database offers many opportunities to identify previously unknown trends or networks. So, for example, a statistical analysis might reveal that a financial institution is filing a growing number of SARs relating to recently opened accounts. That information will be extremely valuable to a supervisor when assessing the onboarding policy of that particular institution for new customers. But no matter how valuable SARs can be, they only provide one part of a broader picture that is needed to understand money laundering risks, which is why it is critical for authorities to also draw on other forms of data. And the paper reviews two categories of such additional data: systematic transaction data and non-transactional data. So what do we mean by systematic transaction data? Well, as we just saw, FIUs tend to receive information about transactions that financial institutions deem suspicious. By contrast, systematic transaction data refers to data on transactions that meet objective criteria that were set by the competent authorities. So on this infographic, you see the three most common criteria used by authorities to define subsets of transactions. First, whether a transaction is above a certain threshold. Second, whether it's cross-border. And third, whether it is conducted using a particular payment method, such as cash. And all of these criteria can be combined to define smaller subsets of transactions, say, for example, any cross-border transaction above a certain threshold. Now, the paper reviews a number of ways to collect systematic transaction data. But what is important to emphasize here is that collecting bulk data is not the only option. To the contrary, a number of authorities have been using aggregate transaction data, which is less detailed but still provide insights into trends that wouldn't be noticed just based on SARS. So, for example, financial institutions in a number of countries provide periodic reports on the transaction volume per corridor. And past experience shows that even where the underlying transactions wouldn't in themselves trigger a suspicion, certain risks or patterns will become apparent by looking at an overall trend, say, for example, an increase or a sharp decline. And generally speaking, systematic transaction data is extremely useful in providing that kind of benchmark that you need in order to monitor and analyze trends. So monitoring financial flows is of course an important part of AML data analytics. However, financial flows also need to be looked at in context, which is why it's important for authorities to also draw on non-transactional data. And that data can serve at least three different purposes. First, it can help identify links that wouldn't be apparent just based on financial data. So for example, links between companies that have a common director. Second, it can help provide the context that is needed to determine if financial flows are unusual. That includes, for example, trade data or shipping data, as well as demographic information, which will help answer the question, are the financial flows that were observed consistent with what you would expect based on other sources of information? Third, non-transactional data will also help assess the business model of supervised institutions. That includes data on the number of customers from certain jurisdictions, as well as the number of politically exposed persons that hold an account with a certain financial institution. But of course, collecting data is not an end in itself. So we will now turn to the various methods that have been used to turn data into knowledge that can help support AML objectives. There are many ways to analyze data, mainly depending on the objectives as well as the data that is actually available. So the paper reviews different methods, and we will now focus on two of these. The first use case is based on the analysis of a dataset over time. In this scenario, financial institutions are required to provide monthly updates to the FIU, stating, for example, the total volume of cash transactions per corridor. Using that data, the FIU noticed a sharp decline in remittances to a particular country over a 3-year period when remittances to other countries were broadly stable. That triggered additional verifications, and it became apparent that many remittance agents operating on this corridor had joined other payment institutions that did not declare their activities to the FIU and therefore posed a higher risk of money laundering or terrorist financing. That shift wouldn't have been apparent just from SARS and could only be identified based on more systematic data. More generally, tracking financial flows at the macroeconomic level is extremely valuable in identifying risk displacement. So for example, how do financial sanctions against country A affect financial flows to country B? And what could that mean for potential evasion schemes? The second use case relies on the combined analysis of transaction data and contextual information. In this scenario, the FIU receives aggregate data from money remitters broken down by the location of the agent as well as the country of the recipient. Now, the most common approach to this kind of data would be to determine which money remitters or agents are the most exposed to high-risk jurisdictions. But going beyond that, the FIU in question also used the information to determine if the destination of funds was consistent with the demographics of the area in question. So that means, for example, that the method was used to determine if money remitters in a certain region A were used to transfer funds to country B, when in fact very few nationals of country B live in this area, which could indicate that the financial flows in question are not remittances, but could represent the proceeds of crime.
So far, we have done a horizon scanning to understand how data analytics had been used to date and with what benefits. The objective for the final 5 minutes will be to see what this means concretely for authorities that are seeking to make greater use of data analytics for AML purposes.
Just like in other areas of AML, there is no gold standard when it comes to the use of data analytics. Rather, the approach should be informed by a number of different factors. And those factors can be broadly or grouped in 2 categories. Contextual factors that relate to the broader national context of a particular country, and operational factors that relate to the specific authorities that are seeking to use data analytics. Contextual factors include things like the threat landscape of a particular country or the economy. So you see here a list of a few examples of such factors and how they can affect the approach that should be taken to data analytics. For example, the crimes that generate criminal proceeds might not be the same in every country. And if a country is faced with high risks of tax evasion, then information on cross-border transactions is likely to be seen as particularly critical for AML purposes. Another contextual factor is the data protection regulation in a particular country. So, for example, under the EU's new General Data Protection Regulation, the GDPR, the collection and processing of data must be necessary and proportionate to the objective pursued. Now, these factors need to be taken into account at every step of the process for deploying an AML data strategy. And the paper offers recommendations on how to run that process. The flowchart that you see gives an overview of the key steps that authorities should take when devising and implementing an AML data strategy. First, it is important to be clear about the objectives for that exercise. So what are authorities seeking to achieve specifically through data analytics? That will require close consultations between the data analyst on the one hand and the end users of the analysis on the other. So that could include investigators or, for example, supervisors who engage directly with financial institutions. Once the objectives and the priorities are clear, relevant authorities will be able to identify the data sets that are the most central to these objectives. And this should always start with a good understanding of the data that is already available either to that authority or to others, to make sure that additional data is only collected as needed. Now, there are often many data sets that will be relevant to a certain objective. Generally speaking, the more detailed the data, the more accurate the analysis will be. So, for example, granular transaction data provides more insights than aggregate data. At the same time, granular transaction data is also more likely to contain more personal information and therefore to raise more privacy concerns. This is why it is important to always have an assessment to determine whether the additional value of collecting personal data is sufficient to justify the additional intrusion. In other words, is the limitation of privacy proportionate to the benefits of that data? There is no simple answer to that question, and the assessment should always be done on a case-by-case basis and should also be informed by a good understanding of the value of that specific data point. Another important element of identifying relevant data sets is the engagement with the public sector as well as with authorities in other countries in order to understand existing models. The research revealed that authorities are not always aware of what their counterparts in other countries are doing. This leads to a fragmentation of approaches and also limits the room for peer learning as well as for synergies at the international level. Of course, in certain cases, different approaches might be justified based on factors that might be specific to a particular country. However, those differences should always be informed by a prior review of all the available methods. So once the relevant data has been identified, the next question is, how should that data be accessed? Traditionally, this has been done by introducing new reporting requirements. However, new technologies are starting to allow authorities to analyze encrypted data without storing it in a central location, which reduces privacy concerns. So, for example, an agency should soon be able to analyze large data sets and to review the outcome of that analysis without reviewing all the underlying data. That, of course, requires close consultations between the public and the private sector, as is currently happening in the context of various financial information sharing partnerships, such as the Joint Money Laundering Intelligence Task Force in the UK or the Fintel Alliance in Australia. So most authorities that have been using data analytics have a process in place to ensure the accuracy of that data. That is based on the recognition that the usefulness of data analytics is a direct function of the quality of the underlying data. Once the data has been analyzed using one of the methods set out in the paper, the next question is how the results should be used. And one challenge here is that the end users might not be familiar with data analytics and the potential benefits. This reinforces the need to engage the end users from the beginning of the process so that they have ownership of the process and know how to use the outcomes. This also means that data analysts should make sure to translate the outcomes of the analysis into a standard language that can be understood by non-specialists. Last but not least, the effectiveness of data analytics should be regularly assessed. In other words, authorities should determine to what extent a certain model has achieved the initial objectives. So, for example, in the context of supervision, an authority might measure the ratio of on-site inspections that have led to a request for corrective measures. If that ratio increases, this can be an indication that the risk mapping has become more accurate as a result of data analytics. This assessment of effectiveness can then lead to further improvements of the analytical tools.
This was a brief introduction to our research on the use of data analytics for financial intelligence, supervision, and enforcement. Thank you very much for listening in, and please feel free to get in touch if you have any comments or feedback. I'm Olivier Kraft from RUSI Center for Financial Crime and Security Studies, and you can reach me and my colleagues by email at cfcs@rusi.org or tweet at us at cfcs_RUSI. Thank you and goodbye.